In 1971, the world changed forever. For the first time in 5,000 years of history, money was no longer backed by gold, only paper and trust. From that moment on, governments could print money without limit. And they did. Trillions of dollars. In just a few years, especially after 2008 and then 2020, money appeared faster than at any other time in human history. But there is something strange. While the public believes that gold is outdated, while we believe in digital money, central banks, the ones who print money, are quietly buying gold. Hundreds of tons each year. Why? If the current system is completely stable, why do they still keep 8,000 tons of gold in their vaults? What do they know that we do not? Gold survived the collapse of Rome, the Spanish Empire, the British pound, world wars, and now it is quietly returning. The question is not, does gold have value? The question is, if one day trust in paper money wavers, what will you hold? What makes gold different is not its color, not the fact that it shines, but something far simpler. What makes something become money? For an object to become money, it must meet a few conditions. First, it must be scarce. It cannot be created at will. Second, it must be durable. It does not decay. It does not disappear over time. Third, it must be divisible. It can be traded. It can be measured. Gold, by coincidence, meets them all. And that is why, 5,000 years ago, when humans did not yet understand banking, when there were no stock markets, when there was no paper money, they were drawn to that yellow metal dot. Around 3000 before Christ, the ancient Egyptians mined gold from the Nile River, but they did not use it to buy bread. They used it to display power. To them, gold was the flesh of the gods. Pharaohs were buried in gold. Temples were covered in gold. The symbol of immortality was also gold. At that time, gold was not yet money. It was a symbol of faith. And that very faith laid the foundation for gold's later monetary role. Around 600 before Christ, a small kingdom named Lydia changed history. Instead of exchanging raw lumps of gold, they began minting standardized coins. On each coin was the king's seal of guarantee. No need to weigh it again. No need to doubt. Just trust the seal. For the first time in history, gold became official money. And from there, it spread to Greece, Rome, all of Europe. But the story did not stop there. Because when an empire expands, when wars need funding, when armies need salaries, a problem begins to appear. Not enough gold. And when there is not enough gold, people begin to mix it. Reduce the gold content in the coins. Make the coins smaller. Mint more, but with less real value. That was the inflation of the ancient world. The Roman Empire did it. And when money lost value, trust began to waver. The first lesson appears here. It is not gold that creates value. Trust in value is what determines it. And when trust weakens, the system begins to crack. But what is interesting is this. Even when Rome collapsed, gold remained. Even when the Spanish Empire disappeared, gold was still traded. Even when the British pound once stood at the center of the world, gold did not vanish. Why? Because unlike paper money, gold does not need a government's promise. It does not depend on policy. It does not require faith in any individual. It only requires scarcity. And the story truly becomes dangerous when the world decides to abandon gold. By the 19th century, the world had finally found a stable solution. If gold was too difficult to transport, If carrying bars of metal was inconvenient, then do something simpler. Print paper money. But each note, backed by real gold, that was the gold standard. Meaning, if you held a dollar bill, you could go to a bank and exchange it for physical gold. Not because the government promised, but because the law required them to hold gold in reserve. This created a limit. Governments could not print money at will. To print more money, they needed more gold. That system created what markets love most: stability. Prices did not skyrocket. Money did not suddenly lose value. Trust was maintained. For nearly a century, gold became the foundation of global trade. But then, war happened. And war is always expensive. Very expensive. To pay soldiers, to manufacture weapons, to sustain an entire wartime economy, nations needed money. A lot of money. The problem was, they did not have enough gold. And when you are bound by gold, you cannot print more. So what did they do? They suspended gold convertibility. Temporarily. Only until the war ended. But temporary, in finance, often lasts forever. After the First World War, many countries tried to return to the gold standard. But the cracks had already appeared. Then came 1929. The Great Depression. Banks collapsed. Businesses shut down. People rushed to withdraw their money. Governments needed to inject liquidity. But the gold standard tied their hands. And then a shocking decision occurred. In 1933, the United States government banned citizens from owning gold. All gold had to be surrendered to the state. In exchange for paper money, from that moment on, gold gradually moved from the hands of the people into the hands of the government. The system continued for a few more decades, under the name Bretton Woods. The United States dollar became the center, and the dollar was backed by gold. $35 per ounce. The world trusted America, trusted that the gold was there, trusted that the system was solid. Until a question emerged. What would happen if America printed more dollars than the gold it actually possessed? And that is exactly what happened. In the 1960s, America spent on the Vietnam War, spent on social programs, spent on growth. Dollars flooded the world. Nations began to doubt. They demanded to exchange dollars for gold. And America realized it did not have enough gold. On August 15th, 1971, President Richard Nixon appeared on television. He said one short sentence. America would suspend the convertibility of dollars into gold immediately. The gold window closed. And just like that, for the first time in 5,000 years, money was no longer linked to gold. We entered the era of fiat money. Money exists because the government says it has value. Because we believe it has value, no more physical limit. No more gold constraint. Only policy. And from that point on, the money supply began to rise. In 1971, the total United States money supply was about $700 billion. By 2008, more than $7 trillion. After 2020, trillions were injected in just 2 years. A very large portion of all the dollars that have ever existed was created recently. What does that mean? It means the current system depends entirely on trust. Trust that the government will not print excessively. Trust that inflation is controlled. Trust that paper money will retain its value. But while we believe, there is a notable detail. Central banks, the ones with the authority to print money, are buying gold. Hundreds of tons each year. They do not speak much about it, but they do it. And the question returns to the starting point. If gold is outdated, why do those who understand the system best still hold it? Is gold money? Or is gold insurance? And if one day trust wavers, Will we remember why our ancestors placed value on a metal that cannot be printed? Let us pause for a moment. If gold is the solution, why did the world once abandon it? The answer is not as simple as governments are greedy. The problem with gold does not lie in its value. It lies in its limitation. When the economy was small, when trade was slow, when the population was limited, gold was enough. But when the world entered the industrial era, when global trade exploded, when billions of people needed credit, needed loans, and needed liquidity, gold began to feel rigid because the supply of gold grows very slowly. While the economy can grow very quickly, what does that mean? It means that if the gold standard had remained, money could have become too scarce. And when money is scarce, the economy can suffocate. That is why many economists argue leaving gold was inevitable. Fiat money allows flexibility, allows rapid response, allows rescue when crises occur. But every form of flexibility has a cost, because when there is no longer a physical limit, the only remaining limit is discipline. And fiscal discipline is not always maintained. Look at history after 1971. When gold was separated from money, the price of gold did not disappear. It rose. From $35 per ounce to more than $800 in 1980, then it corrected. Then it rose again. Then it corrected again. But the long-term trend, gold has never returned to $35. Because when the money supply grows faster than the gold supply, the price of gold reflects that. But there is something important. Gold does not generate cash flow. It does not pay interest. It does not develop technology. It does not increase productivity. Gold simply exists. So the real question is not, is gold good? But rather, in what context is gold good? When the economy is growing strongly, when interest rates are high, when confidence in currency is solid, gold is often not the first choice. But when inflation rises, when public debt expands, when the financial system trembles, gold returns as a refuge. That is not because gold changes. It is because trust changes. And here is the core point. The entire modern monetary system is an experiment based on the belief that governments will manage the money supply responsibly. Central banks will control inflation, and debt will always be refinanced. Most of the time, this experiment works. But history teaches us one thing. Every monetary system eventually changes. Rome once dominated with the denarius. Spain once dominated with silver and gold from the Americas. The British pound once served as the global currency. Now it is the United States dollar. The question is not whether the current system will collapse tomorrow. The question is, in the next 50 years, the next 100 years, will it still look like it does today? And if a major change occurs, what is the thing that depends the least on someone else's promised gold? Not because it is perfect, but because it carries no counterparty risk. You do not need anyone to repay it for it to have value. You do not need a server. You do not need a network. It only needs to exist. But then a new question emerges. In the digital era, when crypto was created, when central banks developed national digital currencies, does gold still have a role, or is it merely a legacy of the past? Perhaps the answer is not either gold or paper money. Perhaps the answer is balance. Because 5,000 years of history show one clear truth. Human beings always seek two things: flexibility and stability. Fiat money provides flexibility. Gold provides constraint. And perhaps a sustainable system in the future does not lie in eliminating gold, nor in fully returning to the gold standard. But in understanding the true nature of both, because in the end, gold is not just a metal, it is a collective memory of the times when trust was broken. And when you understand that, you will no longer ask, does gold have value? You will ask, when everything trembles, do I want to depend on a promise or depend on scarcity? For 5,000 years, empires have risen, empires have fallen, currencies have appeared and then disappeared. Names have changed, forms have changed, systems have changed, but gold has remained. Not because it is smarter, not because it yields more, but because it does not require anyone to promise anything. Rome once believed in its own currency. Spain once believed in the treasury of the New World. Britain once believed the pound was immortal. Every era believed its system was sustainable, until it was not. The thought worth reflecting on is, not gold will replace fiat money, but rather, can fiat money last forever without any natural constraint? After 1971, we entered a new era, the era of unconstrained money, the era of policy, of interest rates, of economic stimulus. And most of the time, it works. But history always whispers a warning. When the money supply grows faster than real value, when debt grows faster than growth, when trust becomes the most fragile asset, people begin to seek what requires no promise. Not because of panic, not because of pessimism, but because of precaution. Gold is not magic. It does not solve every crisis. It does not create the future. But it is memory. Memory of times when money lost value. Memory of systems once believed to be immortal. And perhaps that is the true reason central banks still hold thousands of tons of gold in their vaults. Not to return to the past, but to prepare for the future. So the final question is not, should you buy gold? The question is, what do you believe in? A flexible system that depends on human discipline, or a rigid metal that cannot be printed? Because in finance, in the end, everything revolves around trust. And trust always has a price.